Welcome to Multibagger Shares. I'm Manish Goel, SEBI registered research analyst, and today we're discussing one of the most dangerous and least understood cognitive biases in investing: survivorship bias. Every investor has heard stories like, if you invested 10,000 rupees in Infosys in 1993, you would have 15 crores today. These stories are factually accurate, but they hide a devastating truth. You are only hearing about the winners. The hundreds of companies from that era that went bankrupt, got delisted, or became penny stocks. Nobody tells those stories. This is survivorship bias, the logical error of drawing conclusions from a dataset that only includes survivors while ignoring failures. Think about the SENSEX. When it was constituted in 1986, it had 30 stocks. Fewer than half of those original companies remain in the index today. Companies like Premier Automobiles, Mukund Iron, and Zenith Limited were once blue-chip giants. Today they're either delisted or penny stocks. But when someone shows you 30-year SENSEX returns, these catastrophic failures have been automatically replaced by new winners. The same bias corrupts mutual fund data. When you see that equity mutual funds delivered 15% over 20 years, remember, hundreds of underperforming funds were merged or shut down. The dead funds were removed from the dataset. During World War II, statistician Abraham Wald studied bullet holes on surviving bomber planes. Military leaders wanted to armor the damaged areas, but Wald pointed out the critical flaw. They were only studying planes that survived. The planes hit in the engines never made it back, so they needed to armor the areas with no visible damage. As investors, we must think like Abraham Wald. Don't just study the multibaggers. Study the failures. Let me give you a real example. Titan Biotech, currently trading at 454 rupees with a market cap of 1,877 crores and ROAS of 16.9%, stands out in the biotech small cap space. But dozens of similar companies from the early 2000s are now delisted or penny stocks. Titan Biotech survived because of measurable qualities: debt to equity of just 0.02, 14 consecutive years of dividends, zero promoter pledging, and genuine R&D across 100 countries. Here are 5 steps to defeat survivorship bias. First, study failures with the same intensity as successes. Why did Satyam collapse? Why did Unitech go from 500 to 2 rupees? Second, be skeptical of backtested returns. Any backtest that doesn't include delisted companies is fundamentally flawed. Third, focus on process, not outcomes. As Warren Buffett said, wide diversification is only required when investors do not understand what they are doing. Concentrate on your 5 to 10 best ideas. Fourth, use pre-mortem analysis. Before investing, assume it has failed in 5 years and work backward to identify what went wrong. Fifth, demand quality metrics that predict survival. Low debt, high interest coverage, consistent cash flows, rising promoter holding, and genuine competitive advantages. And here's the key insight. Survivorship bias actually argues against wide diversification. If you blindly diversify across 50 stocks, you are almost certainly buying future failures. The greatest investors, Buffett, Munger, Pabrai, Jhunjhunwala, made fortunes through conviction, not diversification. Remember SEBI's finding: 9 out of 10 individual F&O traders lose money. That statistic includes the losers. F&O trading is gambling. Stick to quality stock picking and long-term value investing. For deeper learning, check out our free value investing education course on YouTube. Subscribe to Multibagger Shares and join our Telegram channel at Long Term Equity Y for daily insights. Thank you for watching.